So we're doing a panel on distributing finance. How can transition finance reach its goals? So transition finance, for those who don't know, is about how you help those fund, not the people who are already there already, the greenest companies, but those who are on their way there. And it's especially a problem in emerging markets and poor countries where they face a much higher cost of capital. So these investments are harder to justify, but they're more needed. And it's been I guess there's been challenges and opportunities for transition finance over the last couple of years. The rise in fossil fuel energy prices have, they've incentivized exploration and so on, but they've woken people up to the need how renewable energy can help with energy security. And higher interest rates have harmed investment worldwide, but especially in emerging markets. So to talk about this, I'm joined by, let's get the names right, Nicoletta Centofanti, who's with the Luxembourg Sustainable Finance Initiative. Laura Hillis, who is Director of Climate and Environment at the Church of England Pensions Board. Kate Levick, Associate Director of Sustainable Finance at E3G. And Karl Andersen, the Managing Director at Greenlight Capital. So we've got people from the policy side and from the investment side. So I'm going to suggest we start with Nicoletta. And I'd just like to ask you about how blended finance is seen as the solution to these different problems of transition finance.
Thank you very much. Welcome. It's a pleasure to be here today. So, as you mentioned, Gavin, blended finance that has been mentioned today, even by Philip and Steve as keynotes today, is a fundamental yet underused approach to mobilizing new resources of capital for the SDGs. I'm taking the OECD definition so that we have all the common level playing field. Blended finance consists of the strategic use of development finance for the mobilizations of additional finance towards sustainable development in developing countries, and this is key, as you were mentioning before. It's important to underline that blended finance is not an investment strategy, but a structuring approach that can take various shapes. I will try to a high level describe what are these shapes, allowing different organizations with different investment objectives to invest alongside each other. So it has three main characteristics. So the transaction contributes to achieving SDGs. The transactions expect to lead. Can you hear me well? Sorry, I knew I would have had problems. My panelist colleagues know that. The transaction expects to yield a positive financial return, and the public or philanthropic parties are catalytic. That means that they really have the mandate, the purpose to improve the risk-return profiles of this transaction. So maybe just in a nutshell, the key structures that are mostly used, because in fact blended finance, it has been used already for a couple of decades, so it's true that it's challenging and it's complex, but there is still some narrative, some science-based background that confirms it's a business model to be pursued. So the main structure that are currently used are private equity or debt funds, as well as bonds or notes issuance. And here the concessional or philanthropic funding is used really to de-risk the investments. Otherwise, this grant funding can be used to support what is called Technical Assistance Facility, TAF, that is supporting the ecosystem to achieve the expected return and the impact. And finally, the grant funding can support the design of the structure of the fund.
Great. So that's blended finance. I wondered if, Kate, you could tell us a little bit about how this has already been used with intergovernmental efforts or how people are constructing this to improve transition finance.
Yeah, sure. Thank you. So, first of all, I think it's important to say that it's not only emerging and developing economies that need to transition. Every economy needs to transition, and that's going to require a huge amount of finance. People love waving around big stats, and I'm always slightly unsure about how they're calculated, so I'm not exactly going to do that. But we need trillions, and we need that to be massively ramped up by 2030, which is coming up very soon. So that's the big challenge. And of course, for the really big economies, the BRICS, and then the slightly smaller emerging developing economies, this is a huge, huge challenge, and that's obviously the focus for this panel. So I think, you already alluded to, Gavin, this is happening in the context of some quite big mega trends. One of those is the rapidly falling cost of renewable energy, which is really changing lots of things about the energy system, but also creating new challenges. Another is that there are, some very interesting, shall I say, geopolitical tensions in play, and that's also getting in the way of how we do the global transition, or at least making it more complicated. And the war in Ukraine, of course, has had a huge effect. That's making it quite difficult for governments to send clear forward signals about what their intentions are for their net zero transition, and that's very much close to home in the UK in the last couple of weeks. So I'm sure everybody recognises that. So in that context, there are some sort of whole of economy transition efforts that we can note. In the last couple of years, we've seen the emergence of the Just Energy Transition Partnerships, the JETPs, where different governments and multilateral bodies are working with a whole range of stakeholders in big emerging economies to try and plan a whole of economy transition, in this case specifically for energy, but that's a very big piece of the transition, for those countries to create a way that can be funded through a mixture of different kinds of donors. Really, this is the kind of blended finance with different motives and incentives that was just being talked about. Those are interesting as an approach. It's very novel. It's probably the scale of ambition that we need for a particular geography, but those are not yet proven. We haven't actually seen one of those work yet, and there's an awful lot of countries that are going to want one of those kind of agreements. We can't keep negotiating those one by one. There has to be some kind of much more large-scale, global way of doing that, and maybe some more international financial architecture that can manage that. So in lots of different ways, we see momentum growing for some kind of bigger international system reforms. I think we'll see how that pans out. Again, there's going to be a lot of politics and geopolitics to get there, but there's the potential for that to really happen in the next couple of years. But it's not just about finding ways for the money to go into those countries. It's about how those countries can use the money, whether they're equipped to do that, whether the national sort of infrastructure and capabilities are there. So there's a lot that has to be done at national level, including clear national policies for transitions, and actually for supply chains and infrastructure to be ready to pick it up. We all know about the wall of money versus the project pipeline problem. That's there as well. So there's a lot that needs to happen in countries. That's where I'll pivot to what I think I'm officially billed as for this panel, which is being the co-head of the Secretariat of the UK's Transition Plan Taskforce. So one of the things that has emerged in the last couple of years, which I think is helpful, is that increasingly private sector firms are being expected to disclose climate transition plans. And those are not only about their operational emissions, they are really looking at their scope 1, 2, and 3 emissions. You see that coming out very clearly in the emphasis that was in the transition finance principles that the US Treasury put out a couple of weeks ago, for example. And we see that kind of expectation emerging and regulatory moves happening in lots of different jurisdictions. In the UK said at COP26 that it was going to require firms to publish climate transition plans. It created the Transition Plan Taskforce to say what a good transition plan looks like. And the taskforce will be launching the final version of that sector-neutral framework on Monday. I have to plug that. So please, if you haven't seen that, please register and do follow that. That's going to be an important move. So a key question is, as we create these new regulations, and there is very much worldwide a pivot towards governments taking this in hand and regulating and setting clearly their expectations for firms to work through their supply chains, including through emerging markets and developing economies. How will that incentivize investment into those economies rather than just create more burden or more barriers to investment? And we have to get that right in order to get this global transition to mobilize that capital at scale that I talked about at the beginning. I hope I didn't go on too long.
It's okay. Let's bring a bit of the investor perspective in here. So I wondered if, Laurel, you could tell us a little bit. So we talked about, I often hear this phrase in these situations about unlocking private finance, which I think is a little bit ugly. But how do you unlock it? What are the barriers? Why is that the reason why there can't be more money coming into these areas.
Sorry, was that me or Karl?
That was you.
Okay, great.
That's Laura.
Thank you, and thank you so much for having me. So I work for a very small pension fund, the Church of England's pensions board. So we have 3.2 billion in assets under management, which sounds like a very large number if you don't work in finance, but it is actually a very small number if you do work in finance. And the reason that we're interested in this issue, but more broadly I'm interested in this issue, is we are convening a group of 12 UK pension funds. It has an incredibly long name. It's the Emerging Markets Just Transition Investing Initiative. And so the idea behind that is we wanted to get together with some of our pension fund peers to try and figure out how can we actually accelerate this process of getting pension fund capital into the climate transition in emerging markets, because as has already been discussed, this is a massive gap. There are a whole range of reasons that gap exists. Some of them relate to kind of very good things. Most of us would be happy to think that our pensions are being invested very cautiously and responsibly, and that is certainly part of the regulatory infrastructure that's set up around pensions, not just in the UK, but globally. I also wrote a report on this same topic, talking to Australian superannuation funds about the barriers and opportunities for them to invest in the climate transition in emerging markets as well. And you get a very similar set of barriers and opportunities from those pension funds in Australia as you do in the UK. So some of the things that are getting in the way, as I mentioned, the regulatory infrastructure makes it a little bit tricky. The other thing is pension funds tend to have relatively small investment teams. So often you're probably not going to have someone in that team who is investing in, you probably won't have, say, an infrastructure investment team. And then within that team, you probably wouldn't have someone who has the kind of specialist skills to go in and invest in, say, an offshore wind farm in Vietnam. You have to have a really special set of skills to do that, which is part of the reason why asset owners like ourselves tend to work with asset managers, because they do bring that kind of expertise. But even so, you still need to kind of have that sense of confidence in your ability to do those transactions, to be part of those transactions at the end of the asset owner, in order to get the confidence that you're still going to be delivering on your risk return needs as a pension fund. So there's that issue as well. And then I'd probably say on the opportunity front, there's a whole range of things that we can be doing as pension funds to address this. Pension funds currently represent about a third of assets under management as well. So this is one of the reasons why this is a really important issue. If we can kind of unlock this, there's huge potential. And the other thing is, if you think about it, many of you in your room will be expecting to get your pension kind of in the 2060s, 2070s, 2050s, and that's quite a long time horizon. So we actually have quite a bit of time to be thinking, okay, not just what is the return that we want to be getting for people over that period, but also what is the kind of world that we want them to retire into. So there's a good motivation for us to tackle this. Blended finance is definitely one of the options and one of the potential opportunities for us, but I think that it's not a silver bullet solution, unfortunately. I think a lot of us would like it to be. There's a few reasons for that. There's simply not enough public finance to make that happen at the scale we need, but also there's some barriers in terms of really helping the kind of public finance, development finance side of this picture really understand and know how to work with institutional investors, which is something that has happened to an extent, but needs far, far, far more work and collaboration. And we also need to, as an institutional investor community, be willing to kind of step forward and say, this is something we want to do, and let's work together to try and make it happen. So that's why we have this initiative and why we're trying to work on it. But I will stop there.
Okay. Finally, then, Karl, I know there's some opportunities as well in this area that you'd like to talk about. Do you want to sort of tell us your perspective?
Yeah, sure. Well, Greenlight Group, we're a growth equity fund, and we invest mostly in Norway and the Nordics. And so, our experience there is, what's nice about the Nordics is Norway in particular is an oil country and has put a lot of money into the renewable energy transition, probably starting in 2015. Last year, about 82% of the cars sold were EVs. And so what you get from that is sort of these learned experiences. It's not just about the new technology that we're looking at investing in, but it's the adoption cycle of Norwegians. And so we've learned sort of how to get product into market. So a big hole that we see that needs to be filled is in our grid systems. Our grid systems are failing globally. It doesn't matter if you're in an emerging nation or in a developed nation. In the U.S., we have to triple the size of our grid, by 2030, 2040. It's a big ask, and we can't even fix it right now. So how do we get people off the grid through technology. Well, there's microgrids, there's fractal grids, but we really have to focus on the user experience. So the best way I can relate this is, I asked my wife, like last month, how many kilowatt hours did we use of electricity? She has no idea. She looks at me like, what are you talking about? Your grandparents probably have no idea how this works. If you're going to get mass adoption at mass scale, you need to have a common language. Everyone knows how to charge their phone. How much battery do we have, for example. If we put batteries in each home or each land sort of property, then we can understand. Then people can understand. Okay, this is how much battery usage we get, and then we can input various renewable energy inputs: solar, rooftop solar, for example, wind applications, sort of urban wind applications, anaerobic digestion, hydrogen. It doesn't really matter the input, but people now have a common language to work from. And I think that's super important because every time we sort of have these big conversations, the conversation usually starts with the grid operators or the institutions or no one's focusing on the user experience. So I'll give you another example. Again, on the grid systems, we've invested in it's an energy management system that basically controls all your renewable energy input for sort of what I would call corporate-owned renewable energy. So you have land asset owners of various types, farms, and then think about your Fortune 5,000 companies. They really want to be able to decarbonize. But what's an obvious solution? They don't really have, there's solutions out there, but if you get them on this sort of energy management system, okay, now I can control the electricity of my assets. That's fair enough. But the dashboard itself still talks in kilowatt hours and still talks in a confusing language. So most of our job is to simplify that and invest in technologies that are applicable there. And so I think there's another thing that we look at is how quickly can we get these products as cheap as possible. What we've noticed in adoption cycles, and this is true in America, you see a lot of conflict about the transition. I'm sorry, I lost my track of thought, but there's.
I wondered if you could talk a little bit about how does finance fit into this picture? So you've got this great technology. What is it that finance can bring to it to really accelerate it? What is it the role that you play in that cycle?
We just, bring capital. We underwrite the technology. We look at how simple it is, and we try and invest in it. I think in America, you obviously have the Inflation Reduction Act, which is good. That helps subsidize, a lot of the companies, and a lot of our Norwegian companies are now, coming to the U.S. To invest. But and then so that's nice on the public finance front.
I guess the Inflation Reduction Act is that kind of blended finance approach where it's trying to unlock private finance by taking some of the risk. These advanced market commitments for DAC and that kind of thing. Is that sort of the model that you like to see? Or is it?
I do, but, the technology should be able to stand on its own. This is an energy transition, and I feel like if you have good technology, it should be cheaper than the alternative. And that's the only way things are going to transition ultimately. In Southeast Asia, for example, Norfund, which is a co-investor of ours, is looking at Southeast Asia on, the 10 largest megacities are supposed to emerge there in the next 20 years or so. And they're going to either they're either going to use renewable energy or burn whatever's available. And so you have this, so if we don't make an effort to get the cost of capital low on those things, and so, governments can play a significant, they can contribute quite a bit there. But still, the technology itself has to be usable at a cheap price. Okay, fantastic. So we went slightly over with opening remarks. I'm going to open straight up for questions just so we get some in. Okay, you've got one here, and is there anyone else? And one over there. So we go here first and then over here. Do you want to keep your hand up? Sorry, so that Mike can find you. Great.
Hi, good morning. A question for everyone, but in particular for Kate. I'm Vivi, former Unilever, now working on education, in particular executive education. And I'm surprised that in the last 3 hours we have not talked enough about human capital, right? And how we're going to unlearn, learn, and relearn, in particular with decision makers. So in all of this transition, what is your take on how we're going to upskill the workforce, starting from executives down to the people who are going to help us on this transition, whose skills are changing dramatically, and then if we put AI in the mix of all of this, it's just going to get even more interesting. So the question is, what are your views in the transition for human capital, and in particular, for our education systems?
Sure. So I'll take that quickly and then hopefully give a bit of space to others. You know, when we're looking through the Transition Plan Taskforce to define what makes a good transition plan for a firm, one of the things that is really upfront in that is firms need to understand their impacts and their dependencies through the transition. And one of those dependencies is very much on human capital, on skills and capabilities. Employee engagement is really important, as well as community engagement, and that upskilling is fundamentally necessary. I think it's something that, the sort of business school sector, for a long time, people have grumbled that they're potentially not moving far and fast enough in terms of sustainability education. I'm not sure if that's still true. I'm sure it isn't as true as it used to be. But I think that's a sector that also has to look hard at whether it's providing the capabilities that are needed for the transition.
Okay, and then we had the question here. And then we'll go over there next, if that's good.
Good morning. Thank you for this. So my name is Lucky. I am a developer from the Global South. Specifically, I'm working in Sri Lanka, Maldives, and also Cambodia. Now, a couple of things for you. Somebody there mentioned the fact not enough projects. Let me tell you, in these developing countries, there are plenty of projects. The problem is actually accessing the capital to actually make those projects a reality. So if you take an hourglass, you have all this money, and you have all these projects at the bottom, and you have the pincer movement in the middle, which is the ADB, IFC, Green Climate Fund, whatever. If you actually start an application for blended finance or technical assistance or anything else, trust me, you need at least 2 years. You need an army of people who are consultants, like a pancake of consultants, to actually get the paperwork through. So to reimagine the financial architecture of the world, it's very simple in my view. You have plenty of local banks in these countries who have a better understanding of the projects in those countries. They have the infrastructure to actually finance. So they have the ability to collate small projects so that it actually becomes a larger sum. And I think it's high time, if anybody was really serious about transitioning this world into renewables, that people start thinking about that as an approach, as opposed to trying to reimagine some global architecture that is impossible to do. Because all that happens with global architecture is you have to keep hiring Western people at very high expensive interest rates, rates in order to get anything done. So that's just one comment to you. The second...
So I guess then as a question, what are the barriers to working with people on the ground in these countries to get finance there? So you talked about the risk and return for pension funds. Is there any way of getting money directly towards banks in Sri Lanka, for example?
I mean, not for us, because we're a pension fund that doesn't do direct investment. We're just not at the scale that we could do that. You have to be kind of in the many, many hundreds of billions kind of size of a pension fund that you would have teams on the ground doing that type of investment. But I think your point is an excellent one, because I think fundamentally what you're talking about is debt. Banks loan the money to a particular developer, and then they could then basically sell it back to either an asset owner or an asset manager as debt, and then we would get the return from that. I think that is going to be one of the biggest ways that we actually do solve this problem, because the other thing is most investors that are on the more conservative side are actually quite comfortable with debt as an asset class. They're used to it, they have a good sense of what the return profile is over a period of time, and if they're a longer term investor, it tends to work quite well for them. I think that there are still a number of things that we need to deal with, mostly in that I think a lot of it's kind of a risk culture and a risk mentality kind of area, and also bridging these gaps in terms of expertise, as I was talking about before. But I fundamentally think that what you're pointing at is the way forward.
Yeah, it's not just debt.
So I think we'll just get another question, just because we've not got a lot of time left. So we were going here next. Thank you. Sorry about that. It's just I'm trying to get everyone involved.
Hi, I run a company that deploys blended finance into the Amazonian rainforest to stop deforestation. And I can tell you the issue is blended is mostly debt, because you can't really invest equity in this market. But the problem is, if you want to attract private capital, you then need concessionary or loan guarantees and portfolio guarantees. In the US, they have the DSC and USAID, but being here in Europe, I couldn't agree more with the lady there. You'll need a PhD in applying for bureaucracy and, to actually get through to anyone. And we've been running for 3 years just on private capital. And if we were waiting for a guarantee from, let's say, a pension fund, just writing a guarantee because you're concessionary, long-term, you really mean it. I actually think I would like to see more smaller pension funds deploy capital this way, or just write a portfolio guarantee. That's how you mobilize larger asset managers to invest in companies like us. We are a debt fund. Otherwise, I don't think we're just going to be here in 5 years talking the same thing. That's my opinion. I don't know who's going to provide those guarantees. And
I wonder if Karl and Nicoletta, you talk a little bit about the bureaucratic barriers and also the position of an equity investor.
I mean, what we would do is really focus on the project and find some sort of local EPC company. And the EPC is like sort of the engineering, procurement, and construction company, and then figure out a deal with them on the equity side. But I work closely. So Greenlight, we set up a reinsurance vehicle as well. And sometimes the reinsurers are better at underwriting it than the capital markets. And so like groups like Munich Re, Everest Re, we 100% retrocede our risk to them, but they will underwrite deals like what you're talking about in sort of, if it's renewable energy, I mean, I know you're deforestation, but if it's renewable energy projects, 100% they'll do it. So you can figure out ways to insure, if you can underwrite it with an insurance or equity co-investor, that's kind of the silver bullet, but I know what you mean.
They need $100, $200 million ticket, but when you want to deploy capital to people in these countries, they don't need that size of capital initially. You
Right.
have them go up the scale fast on investing smaller capital. This is where I think the smaller institution can also play a key role.
So Nicoletta, is there anything you see about getting smaller institutions dealing with that sort of the trouble of this economies of scale?
Yeah, well, first of all, it's not easy, right? You are all right. But we are all representing different industry with different background, with different objectives, and we need to talk together to channel those investments in those countries that need it the most. I wanted to quote, there's a very interesting tool, for example, that has been developed by the UN Development Program. Particularly, they started with Africa, and they created a pipeline of sectorial opportunities to help the work of investors and funders to identify those opportunities. And there are people like you on the ground that really knows what is happening there. But on the other side, we need to convince or to work, and I'm going back to the capacity building, or let's say the awareness and knowledge construction and support to asset owners and asset managers that needs to invest very far away from them in countries where the risk is perceived as high. I'm saying perceived because sometimes it's really a perception. We also speak about perceived risk rather than actual risk. So, well, I would recommend anyone interested in blended finance to have a look at the projects that are existing. For example, Luxembourg has set up with the EIB, the European Investment Bank, a platform that is called the Climate Finance Platform back in 2017, and they're still looking for projects and for private capital, but also there is a very huge network that is called Convergence that gathers both investors and funders that connects players, identify deal flows, provide market insights and capacity building. So we need to work towards the same objective, but we have very different backgrounds, so we need to work together.
So I'm very sorry. I see there's more questions, but unfortunately I've gone over time on both of my sessions, so I'm going to be in trouble. And so I've got to end it there. But there is now a networking break for, I don't know how long it is, but so you can catch our panel outside, maybe there, corner them, and tell them all about your questions. Thank you. Thanks for joining us.
Thank you.
Thanks for having us.